Welcome back, everyone, to Bull and Bloom for another deep dive.
Oh, I love deep dive.
Me too. Today, we're going to be exploring some listener-submitted thoughts on the stock market.
Oh, interesting.
Yeah. And, well, this crazy thing we call politics, right? I'm Max.
I'm Ella.
And Ella, are you ready to unpack some insights?
Always.
All right, so let's set the stage a little bit. We're looking at some analysis of how the market reacts
Okay.
after a presidential election. The main thing that jumped out at me was this idea that the market often rallies, almost regardless of who wins.
Oh, really?
Yeah, it's kind of a fascinating concept.
Yeah.
What do you think is behind that? Why would that be?
I think it really comes down to certainty
Okay.
or the lack of certainty. Elections always create this, like, a cloud of uncertainty,
I can see that.
And investors get a little skittish.
Of course.
They hold back. They wait to see what policies will be implemented.
Right.
So once the election is over, phew, we know who's in charge.
Yeah.
We have at least some idea of what to expect.
Makes sense.
And that tends to bring investors back to the table.
It's like everyone can finally exhale and get back to business.
Exactly.
And that renewed confidence, does that translate into buying activity?
Absolutely. Often we see a surge of buying.
Which, of course, pushes prices up.
Right.
And we saw this happen pretty dramatically, in fact, this time around.
Oh, yeah.
Think about those pre-market futures jumps. The Dow was up, what was it, like 900 points?
Wow.
Yeah. S&P 500 over 100. And the NASDAQ was surging over 300 points.
All before the market even opened.
Pretty wild. It really illustrates the power of market psychology.
It really does.
But, here's where we need to get critical.
Oh, okay.
Because just because we've seen a pattern in the past
Right.
doesn't mean it's guaranteed to happen in the future.
That's true. Past performance is not indicative of future results, as they say.
They do say that. So if we can't just rely on the past, what should we be paying attention to?
Well, I think it's really important to focus on sector performance
Okay.
because different sectors are impacted differently by different administrations and their priorities.
That makes sense. Now, one sector that always seems to be in the spotlight is energy.
Oh, absolutely.
The source material we're looking at suggests there's potential for gains in energy stocks. But it also acknowledges that energy can be a pretty unpredictable sector.
Yeah, and I think that volatility really stems from how closely energy is tied to political decisions.
How so?
Well, things like deregulation, subsidies,
Right.
infrastructure spending, all these can have a massive impact on energy companies.
It's this push and pull, isn't it? Between political agendas and economic realities.
It is. It
Yeah.
is. And for investors, understanding the energy sector requires understanding the political landscape.
It's all about connecting those dots, seeing how these seemingly separate worlds actually influence each other.
Yes.
Now, the source material also talks about not letting big events, like elections, completely dictate our investment decisions. It emphasizes focusing on the fundamentals of the companies.
I like that approach.
What do you think about that?
I think that's very sound. Long-term investing success really hinges on finding strong businesses, understanding their value.
Their intrinsic value.
Exactly. And then we can use valuation metrics.
To see if their price is justified.
Yeah.
Now, you mentioned intrinsic value. Can you explain what that means for our listeners? How do we figure that out?
Sure. So intrinsic value is basically what a company is truly worth.
Okay.
And this worth is based on its assets, its earnings potential, its future cash flows.
So we're looking beyond the hype
Yes.
to the heart of what makes the company tick.
Exactly. And this means digging into the financials, the company's competitive position, its long-term growth.
It's not a simple calculation, is it?
It's not, but it is essential for any serious investor.
Separating the signal from the noise.
Absolutely.
Okay, so speaking of noise, let's talk about some of the potential negative consequences of these campaign promises.
Okay.
One that comes to mind is tariffs.
Right.
There's a concern they could lead to higher prices.
Inflation.
Inflation.
Yes. The relationship between tariffs and inflation is complex.
I bet.
Tariffs can make imported goods more expensive,
Right.
which can lead to higher prices for consumers.
Okay.
And if these higher prices become, widespread
Yeah.
and persistent,
Persistent.
we could see a rise in inflation.
That's a ripple effect.
It is, starting with the tariffs and potentially impacting the entire economy.
And if inflation starts to climb, what happens then?
Well, then the central banks might step in
Okay.
and raise interest rates.
To try to cool things down.
Exactly.
And of course, that has its own consequences for businesses and investors.
Of course, because higher interest rates make borrowing more expensive for companies.
Impacting their profitability.
Exactly. And they can make bonds more appealing to investors.
potentially pulling money away from the stock market.
Right. It's a delicate balance to strike, managing inflation without stifling growth.
Absolutely. And then on top of all that, we have regulatory uncertainty. The source we're looking at points out this appointment to head the Federal Trade Commission,
Hmm.
someone who is known for targeting monopolies,
Oh, right.
could impact certain types of investments.
Regulatory bodies like the FTC, they really have a huge influence.
On market dynamics,
Yeah, their actions can create winners and losers.
depending on how they enforce regulations and promote competition.
Exactly.
So it's not just the president,
Right.
but also these key appointments.
Yeah.
And how they shape the landscape
Absolutely. Investors need to be aware of these appointments.
and how they might impact certain industries.
For sure. It's another layer of due diligence.
It's all about connecting those dots, seeing those cause and effect relationships,
Yes,
and using that knowledge to make better decisions. We've talked about a lot of risks
we have.
and uncertainty. But the core message is about building a resilient portfolio, one that can withstand anything
I love that. A resilient portfolio is diversified
across different asset classes, sectors, geographies,
and built on solid companies.
with strong fundamentals.
Profitable companies with a competitive edge.
A management team that's focused on long-term value.
Yes.
It's about building a solid base.
That can handle those market ups and downs.
Exactly.
Yeah.
And you know what? I think it's time for a quick break.
Okay.
But when we come back, we'll dive into some specific strategies
Sounds good.
for building that resilient portfolio. We'll explore some actionable insights to help you navigate this market.
I'm ready. So it's about having a plan, a strategy in place.
Right, not just reacting to every headline.
Exactly. Let's talk tactics. How do we build a portfolio that can handle, well, just about anything?
Let's get into it.
All right. So first and foremost, diversification.
Okay, diversification. I've heard that before.
Yeah, it's crucial. Don't put all your eggs in one basket, as they say. Spread those investments out.
Across different asset classes,
Right.
like stocks, bonds, that sort of thing.
Yes. Stocks, bonds, different sectors, too. Think tech, healthcare, consumer goods,
Makes sense.
and even different geographic regions. Don't limit yourself.
So not betting on just one horse in case it, stumbles.
Exactly. Diversification helps spread the risk.
I see. So if one area is underperforming, another might be doing well.
That's the idea. Balance things out. Okay, so diversification, step one. What's next?
What else is there?
Doing your homework
Homework.
on individual companies.
Oh.
Don't just jump in because everyone's talking about a company.
Right.
Look under the hood.
So what kind of homework are we talking about?
Understanding the business model.
Okay. How does the company actually make money?
Right. What are its advantages?
The competitive advantages.
Yes. Who are they up against?
Competitors.
Look at their financials, too. Are they profitable? Are they growing? Are they managing their debt well?
It's like being a detective.
It is.
Piecing together clues to see how healthy and promising the company is.
I like that analogy. Because you're right, you're not buying a stock, you're buying a piece of the business.
So diversification, doing our homework, then what?
Then you need to consider different scenarios.
Scenarios.
Economic scenarios. How would your investments perform if things change?
Okay, give me an example.
What if interest rates jump up? What happens if inflation goes through the roof?
What if there's a recession?
Exactly. Or new regulations come into play.
So it's like playing out these what-ifs in our heads.
Right. You're not predicting the future, you're understanding the risks.
The potential rewards, too, I imagine.
Of course. It's all about being prepared, not just reacting when things happen.
Like having a plan for different kinds of weather.
Exactly. You might not know what tomorrow will bring, but you can have an umbrella ready.
So we diversify, we do our homework, we think about different scenarios. What else can we do to make our portfolios really strong? Any other wisdom you can share?
Remember, investing is a marathon, not a sprint.
Oh, I've heard that one, too.
Yeah, it's about gradual wealth building, not getting rich quick schemes.
Patience.
Patience and discipline. Don't get caught up in the hype.
Or the panic. It's easy to get emotional when the market's volatile.
Very easy. But emotions can lead to bad decisions. So stick to your plan.
Your research, your strategy, don't let those short-term ups and downs throw you off track.
Keep your eyes on the prize.
Remember why you're investing in the first place.
Yes, and there are resources to help you.
Oh, like what?
Financial advisors. Don't be afraid to reach out if you need guidance.
That's great advice. Ella, this has been so insightful.
Thanks, Matt.
You really helped make all of this whole world of politics and investing a little less intimidating.
Glad to hear it. I always enjoy helping people become more informed investors.
Speaking of informed investors, let's talk about a specific company that's been making headlines. Palantir.
Oh, yeah.
I know we've both been following them, and I think it's a perfect case study for what we've been discussing.
I agree. They're fascinating, operating in this really fast-moving space. Data analytics and AI,
Their technology is powerful. They're involved in everything,
national security, healthcare, business intelligence, you name it.
but their stock price has been all over the place.
It has. And that's where valuation metrics come in.
Right, because having a great product is one thing.
But having a stock price that reflects the company's actual value.
That's the key. So how do we figure that out with Palantir?
That's the million-dollar question. A lot of investors are wondering the same thing. They have huge growth potential.
But yeah, the price has been so volatile.
It reflects both the excitement about their future and the concern about overvaluation.
And that's where the deep dive into intrinsic value comes in.
It does. Analyze their financials, understand their competition, project their future earnings.
To see if their stock price is actually justified.
Right. We need to separate the hype from reality.
Which isn't always easy, especially with a company like Palantir.
Yeah, they're in such a cutting-edge field.
It's a reminder that investing requires more than just crunching numbers.
It does. You need critical thinking.
And a willingness to be patient.
Absolutely. Keep your eyes on the long term.
Well said, Ella. Now, before we wrap up, let's circle back to something we talked about before. Inflation. It's a big concern for a lot of people right now. What are your thoughts on how inflation could impact our investing going forward?
It's definitely something to keep on our radar.
Yeah, it makes everything more expensive.
It erodes our purchasing power.
And if it gets out of control.
It can really hurt the economy.
So how can we protect ourselves as investors?
Well, we can invest in assets that tend to do well during inflationary times.
Like what?
Commodities, real estate.
Okay, what about stocks?
Yeah.
Any particular types?
Companies with strong pricing power.
Their pricing power.
The ones who can raise prices without scaring off customers.
Like what kind of companies?
Companies that provide essentials. Or those with really strong brands.
Those with loyal customers.
Right. They have that ability to pass on higher costs without seeing demand plummet.
It's like they have a protective barrier around their business.
Exactly. Now, what about debt? How does inflation affect companies that have a lot of debt?
I was wondering about that.
It can be a real challenge because as inflation rises, the value of their debt decreases.
Okay,
And that makes it harder for them to keep up with those debt payments.
so their costs are rising.
And the value of their debt is falling.
Not a good situation.
No, not at all. That's why it's so crucial to look at a company's debt levels when you're considering investing, especially when inflation is a concern.
So to sum it up, we want companies with strong pricing power and low debt
Those are the ones who can ride out those inflationary storms.
without taking on too much risk.
Right. And remember, diversification is always a good idea.
Don't put all your eggs in one basket, even if it seems like a sure thing.
Exactly.
Ella, as always, this has been so informative.
It's been my pleasure, Max. I always enjoy these.
And to our listeners, thanks for joining us
We hope you're leaving with some new insights.
to help you on your investing journey.
Remember, knowledge is power, especially when it comes to investing.
Stay curious, keep learning, and never stop asking questions. And if you have any materials you'd like us to take a deep dive into, please send them our way.
We're always looking for interesting topics.
We can't wait to see what you come up with next. Until then, keep those minds sharp, keep those portfolios growing, and we'll see you on our next deep dive. You know we've been talking about all these external factors,
Elections, policies, inflation, yeah,
but it all comes back to the individual companies, doesn't it?
absolutely. What makes a business truly resilient when things get tough?
That's the big question, right? What are we really looking for? When we talk about a company's ability to withstand any challenge,
It brings us back to the fundamentals of investing. It goes beyond the numbers,
on the headlines.
It's about finding those businesses that have a real edge, a lasting advantage.
So what are the signs? What makes a company truly resilient?
Think of it like building a house.
Okay, I like that.
You want a solid foundation, right?
Of course.
In business, that's a company with a clear mission
Strong leadership.
and a culture of adaptability.
So they're not just chasing fads.
They're building something that will last.
They have a long-term vision.
Right. And then you need those strong walls to weather the storms.
That's where competitive advantage comes in.
Exactly. Do they have something unique?
A product or service nobody else offers.
Are they the best at what they do?
And can they adapt as the market changes?
It's not enough to just be good today.
You have to be able to evolve, stay ahead of the game.
Think about companies like Amazon, Netflix.
They started in one place, but they didn't stay there,
They kept innovating.
expanding their offerings.
They basically redefined their industries.
They're constantly building new rooms onto that house, so to speak.
I like that, expanding and adapting to what their customers need.
And then, of course, you need a good roof to protect you from those unexpected downpours.
Financial strength.
Can they handle debt
Do they have enough cash flow to get through rough patches?
without falling apart
Right. It's about having that financial cushion just in case.
so they can weather those unexpected challenges?
Economic downturns, changes in how people shop, even global pandemics.
You have to be prepared for anything.
Exactly. And that's why it's so important to really understand businesses.
It's more than just picking stocks.
You're looking for companies that are built to last, with resilience built into their very core.
You want to invest in quality,
Yeah.
companies you believe in, that you can see yourself holding on to for the long term.
Because those are the companies that are most likely to pay off.
No matter what the market does, no matter what happens in the world.
Well said.
Ella, this has been another amazing conversation.
Thanks, Max.
I always learn so much from these deep dives.
I'm glad. I love exploring these topics with you.
And to our listeners, thank you so much for joining us,
We hope you found this deep dive valuable.
and that you walked away with some fresh perspectives.
Some new insights to apply to your own investments.
Remember, knowledge is power, especially when it comes to investing. Keep learning, stay curious,
Never be afraid to ask questions.
and if there are any materials you want us to take a deep dive into,
Send them our way.
we're always looking for new and interesting ideas. We can't wait to see what you send us next. Until then, keep those minds sharp, keep those portfolios growing.
And we'll see you on our next deep dive.